Hello friends, welcome to our channel Accounts and Finance with FARSK. This is our video on the sixth part on the series on the financial accounting ratios, solvency ratios. Hope you will like, share and subscribe our channel. Solvency ratios. The 5 standard financial accounting ratios: liquidity, profitability, solvency, turnover and earnings ratio. Introduction. In general, solvent means to dissolve in other substance. Solvency in finance or business is the degree to which the current assets of an individual or entity exceed the current liabilities of that individual or entity. Solvency can also be described as the ability of a corporation to meet its long-term fixed expenses and to accomplish long-term expansion and growth. Indicates how companies use debt. While debt can help a company get a higher rate of return on its cash investments, too much debt increases the probability of bankruptcy. Solvency ratios are also known as debt ratio or leverage ratio. The problem is when the use of debt becomes excessive, with interest payments taking a large chunk out of top-line sales. A company will have less cash to fund marketing, R&D, that is research and development, and other important investments. Note: solvency ratio measures the company's or organization's ability or capacity to pay long-term debt or non-current liabilities, whereas profitability ratio measures the company's or organization's ability or capacity to pay short-term debt or current liabilities. In some cases, borrowing may actually be a positive sign. Consider a company that wants to build a new plant because of increased demand for its products. It may have to take a loan or sell bonds to pay for the construction and equipment costs, but it's expecting future sales to more than make up for any associated borrowing cost. And because interest expenses are tax deductible, debt can be a cheaper way to increase assets than equity. The types for solvency ratios: debt ratio, debt service coverage ratio, debt or equity ratio, interest coverage ratio. Debt ratio. Debt ratio measures total liabilities with the total assets. It defines how much business is owned by the creditors. Formula: total liabilities divided by total assets. Ideal: anything lesser than 40% is better. Debt service coverage ratio. Debt service coverage ratio, simply DSRO, measures the company's cash flow to meet debt obligations. Formula: net operating income divided by total debt service. Ideal 1.2 and 1.25. Debt to equity ratio. The debt to equity ratio definition is an indication of management's reliance to finance its asset on debt rather than on equity. It measures a company's capacity to repay its creditors. This ratio varies with different industry and company. Comparing the ratio with industry peers is a better benchmark. Also, the debt ratio means an indication of the gearing level of a company. A high ratio means that a company may be over-leveraged with debt. This can result in high insolvent risk since excessive debt can lead to a heavy debt repayment burden. It signifies how much debt the company has in relation to assets. Formula: long-term debt plus value of leases or average shareholders' equity. Ideal: lesser the better. Interest coverage ratio. Interest coverage ratio indicates the ability of a firm to service the debt and repay it over the tenure of the loan. This ratio determines if an entity's assets are enough to cover the interest payments on its debts. The interest coverage ratio for a company is a debt ratio that is designed to give an idea of how able the company is to pay its interest payments. In doing this, you can get a sense not only of how well the company is doing with regards to earnings, but how much debt it is in or is accruing. Formula: net income, that is earnings before interest on taxes, divided by annual interest expenses, or net income divided by annual interest expenses. Ideal: any number greater than 1. Well, that's it for today. Hope you like our video. For more videos, please do not forget to like, share and subscribe our channel Accounts and Finance with FARSK. Thank you. Have a great day.